Diversification is a strategy that involves investing in a variety of assets to reduce the risk of loss in any one investment. The idea is to spread your money across different asset classes, industries, and geographies to avoid putting all your eggs in one basket. By diversifying your portfolio, you can potentially lower your risk and improve your overall returns over the long term. In this video, we will discuss about various diversification strategies which can be applied to reduce the risk of loss. If you like the content, do subscribe the channel and like the video so it may reach to people looking for similar information. There are several ways to diversify your portfolio. Let's check out the different strategies that you can apply to diversify your investments. Number 1. Asset allocation. This involves dividing your portfolio among different asset classes, such as stocks, bonds, real estate, and commodities. The goal is to create a mix of investments that will provide a balance between risk and reward. A common asset allocation strategy is to divide your portfolio between stocks and bonds. For example, you may allocate 60% of your portfolio to stocks and 40% to bonds. Within stocks, you may further diversify by investing in large cap, mid cap, and small cap stocks. Number 2. Industry diversification. This involves investing in companies from different industries, such as healthcare, technology, and consumer goods. The idea is to avoid being too heavily invested in any one sector, which can be affected by industry-specific factors. Let's say you invest in the stock market and want to diversify across different industries. You may invest in stocks from the healthcare industry, such as Pfizer or Johnson & Johnson, and also invest in stocks from the technology industry, such as Apple or Microsoft. By investing in companies from different industries, you can reduce your exposure to industry-specific risks. Number 3. Geographic diversification. This involves investing in companies from different countries and regions. The idea is to avoid being too heavily invested in any one country or region, which can be affected by political, economic, or environmental factors. If you want to diversify across different countries and regions, you may invest in exchange-traded funds or mutual funds that invest in foreign companies. For example, you may invest in an ETF that tracks the MSCI Emerging Markets Index, which includes stocks from countries such as China, India, and Brazil. Number 4. Investment style diversification. This involves investing in different investment styles, such as value investing, growth investing, and income investing. The goal is to diversify your portfolio by investing in companies with different characteristics and risk profiles. Suppose you are investing in stocks and want to diversify across different investment styles. You may invest in value stocks, which are stocks that are undervalued by the market, and growth stocks, which are stocks that are expected to grow faster than the market. For example, you may invest in value stocks such as ExxonMobil or General Electric, and also invest in growth stocks such as Amazon or Tesla. The benefits of diversification are clear. By spreading your investments across different assets, industries, and geography, you can potentially reduce the risk of loss and improve your returns over the long term. Diversification can also help you avoid the risk of investing too heavily in a single stock or asset class, which can be affected by unexpected events or market conditions. For example, suppose you have a portfolio of only tech stocks, and suddenly, the tech industry experiences a downturn. In that case, your entire portfolio would suffer losses. However, if you had diversified your portfolio across multiple sectors, such as healthcare, consumer goods, and energy, the losses from the tech industry would be offset by gains in other sectors. Since we have discussed benefits of diversification, let's understand some of the downsides of diversification. Lower returns. One of the main drawbacks of diversification is that it can lower your overall returns. When you spread your money across different assets, you may miss out on the full potential gains of any one investment. For example, if you had invested all your money in Apple stock in 2002, your returns would have been significantly higher than if you had diversified your portfolio across multiple stocks. Diluted focus. When you diversify your portfolio across multiple assets, you may not be able to fully focus on any one investment. This can make it harder to keep up with news and developments in each asset, and may prevent you from taking advantage of opportunities that arise. Trading costs. Diversification requires you to buy and sell multiple assets, which can result in higher trading costs. This can eat into your returns, particularly if you are investing in assets with higher transaction fees. Over-diversification. There is such a thing as over-diversification, where you spread your investments too thin across too many assets. This can dilute your returns and make it difficult to manage your portfolio effectively. Correlation. Some investments may be more correlated than others, which means they tend to move in the same direction at the same time. For example, stocks in the same industry or region may be more correlated. When you diversify your portfolio, it's essential to consider the correlation between different assets to avoid unintended concentration. To conclude, diversification is an essential strategy for managing risk in an investment portfolio, but it's important to consider the potential downsides. It's crucial to strike a balance between risk and return and to consider your investment goals, risk tolerance, and time horizon when diversifying your portfolio. This brings us to the end of the video. Give a thumbs up if you liked the video and do subscribe to get a notification for upcoming videos. Goodbye and have a nice day.